Welcome to the deep dive. Today we're diving straight into a fascinating puzzle. The Triffin Dilemma.
Ah, yes, the Triffin dilemma.
Imagine a country whose money is used by everyone, all around the world. Sounds great, right?
On the surface, yeah, seems like a fantastic position to be in.
But there's a catch. To supply all that currency, this country often has to spend more than it earns, run a trade deficit.
Exactly. And that, well, it could eventually make people question the strength of its currency. It's a paradox.
This inherent conflict, it was identified way back in the 1960s by an economist, Robert Triffin.
That's right. And for this deep dive, you've gathered some really compelling material to help you, our listener, really get your head around this.
Yeah, we want to explore how this dilemma has played out historically.
And then bring it right up to today. Is the U.S. dollar facing this Triffin dilemma right now? That's the big question.
So our mission today is really to equip you with a clearer understanding of this, well, pretty complex idea and what it means for the whole global financial system.
Definitely. It's a crucial concept.
Okay, let's unpack this. Maybe we should go back to a key moment.
Yeah.
The Bretton Woods system, right after World War II.
Absolutely. Good starting point.
Yeah.
Bretton Woods essentially fixed the U.S. dollar's value to gold. It was $35 per ounce.
$35. And then other currencies were pegged to the dollar?
Precisely. Other major currencies pegged to the dollar. It set up this hierarchy, you could say, with the dollar right at the top, the primary reserve currency.
So central banks everywhere started holding dollars, lots of dollars.
Significant amounts, yes. That became the norm.
Okay, so here's where it gets really interesting and where, the seeds of the Triffin dilemma were planted.
Right.
To keep global trade humming and, crucially, provide enough dollars to meet this growing international demand. What did the U.S. have to do?
Well, exactly. They had to run what we call balance of payments deficits.
Balance of payments deficits. Can you break that down a bit? What does that mean practically?
Sure. It basically means the U.S. was spending more money abroad than it was bringing in. Think imports, investments overseas, foreign aid.
Okay, so money flowing out.
Yeah, that outflow of dollars was the main way they were supplied to the rest of the world. It met that global demand.
But you can already see the problem building here, can't you?
Mhm.
Over time, these deficits mean the pile of dollars held by foreign central banks just kept growing.
And growing until it started to look bigger, much bigger, than the value of the U.S. gold reserves backing them. Remember that $35 an ounce price?
Right. The math started looking a bit shaky.
Very shaky. And this raised an inevitable question, didn't it? Could the U.S. actually keep its promise? Could it exchange all those dollars for gold if everyone suddenly wanted to?
I remember reading France, under de Gaulle, was particularly vocal about this.
They certainly were. France had serious doubts and actually started converting their dollar holdings into gold, sort of calling the U.S.'s bluff.
Which leads us right to a huge event. The Nixon shock, August 15th, 1971.
A truly pivotal day.
What exactly happened? Why was it such a game changer for this whole Triffin discussion?
Well, on that day, President Nixon announced unilaterally that the U.S. was suspending the dollar's convertibility into gold. Just stopped it.
Wow. So basically pulled the rug out from under Bretton Woods?
Essentially, yes. The foundation of the system was gone. Now, while the direct link to gold collapsed, and confidence in that specific system definitely took a hit,
Yeah.
it's really crucial to understand that the dollar itself didn't suddenly, vanish as the top currency.
Okay, so the system broke, but the dollar's dominance, it stayed.
It remained the world's primary reserve currency, remarkably, even without that gold anchor.
So what's the key insight there? What does that tell us?
Well, it shows that even when the formal backing, the explicit promise, collapses, the sheer inertia and the network effects everyone already using the dollar can keep it dominant, at least for a good while.
Okay, Bretton Woods is one clear example, but our sources bring up another case, a historical precedent, the British pound sterling.
Ah,
Yeah,
yes.
Now, for many people today, the pound might seem like, well, less of a global heavyweight. But historically, its role was massive, right?
Yeah.
Especially post-WWII.
Absolutely massive. Even after the devastation of the war, the pound played a major international role, particularly within the sterling area.
The sterling area? What was that?
It was a group of countries, many from the Commonwealth, that pegged their currencies to the pound and held their reserves in, pounds sterling in London.
Okay,
Yeah.
but like the U.S. later, the U.K. had its own economic headaches after the war. How did that fit the Triffin pattern for sterling?
Well, if you think about it, the UK was struggling with post-war reconstruction, their economic growth was kind of sluggish, and they were running persistent balance of payments deficits too.
Sounds familiar.
It does, doesn't it? And all this made it incredibly difficult to keep the pound's value stable while it was also acting as this key reserve currency.
So people holding sterling started getting nervous.
Increasingly worried, yes. Worried about the UK's economic health, worried about the risk of devaluation that the pound would lose value.
And those worries weren't just theoretical, were they? The sources mention sterling crises, plural.
Oh yes, several significant crises.
Yeah.
There was pressure in 1947, then a big devaluation in 1949, another crisis in 57, and then a really tough period from 1964 to 67.
What did those crises look like?
They often involved speculative attacks, people and institutions rushing to sell their pounds because they feared it would be devalued.
So a run on the currency.
Pretty much. The UK government and the Bank of England had to intervene, spend their gold and dollar reserves trying to prop up the pound's price, sometimes even borrow from the IMF.
That sounds incredibly stressful and draining on resources.
Definitely. And each crisis chipped away at the confidence in sterling as a reliable place to park global reserves.
And all that pressure, it eventually led to something major in 1967. A big devaluation.
It did. November 1967. The UK was forced to devalue the pound quite significantly by 14.3%. That was a real turning point.
How did that affect its global role?
Well, the data in our sources shows it clearly. Sterling's share of global reserves, which was around 25% back in 1950.
A quarter of all global reserves.
Yeah. It started a much steeper fall after 67. By the early 70s, it was below 10%, and by 1980, down around 3%.
Wow, quite a drop. What was the exchange rate impact, roughly?
Well, the initial post-war peg was $1 to $4.03. After the 49 devaluation, it went to $2.80. Then the 67 devaluation took it down to $2.40.
And their gold reserves.
They fluctuated. Around 1,773 tons in 1945, peaked at over 2,500 in 1950. But by 1970, they were down below 1,200 tons. The pressure was immense.
So the UK just couldn't juggle managing its own economy and supporting a global currency role.
Fundamentally, no. They couldn't sustain the external balance needed. The loss of confidence was, well, almost inevitable given the circumstances. It really cemented the U.S. dollar's even more central position.
So the key takeaway seems to be, if a country can't manage its economy and maintain its currency's value, its reserve status is definitely at risk.
That's a very good summary of the sterling experience, yes.
Yeah.
Okay, so we have the dollar under Bretton Woods, the pound after WWII. Both seem to fit this Triffin mold. Run deficits, supply the world, lose confidence.
Seems that way.
But then one of our sources throws a really interesting curveball. It looks at the UK before World War I. What was different then?
This is a fascinating counterexample. It really challenges the idea that deficits are always necessary for a reserve currency issuer.
Okay, tell me more.
Well, during the classical gold standard era, say late 19th, early 20th century, the British pound sterling was absolutely dominant. London was the undisputed financial center of the world.
Right, but here's the twist, isn't it? Despite that huge global role, the UK wasn't consistently running trade deficits.
Exactly. In fact, during this period, the UK generally ran current account surpluses.
So they were earning more from abroad than they were spending. How did they supply sterling to the world then?
That's the key question. It wasn't primarily through buying more goods than they sold. It was through massive net outflows of capital.
Capital outflows. You mean investment.
Precisely. The UK was a colossal global investor. They were sending huge amounts of capital abroad to finance railways, mines, infrastructure projects all over the world, especially in the empire, but elsewhere too.
So they pushed pounds out into the world through investment, not trade deficits.
That's the mechanism. By 1913, it's estimated their overseas assets were something like 35% of their entire net national wealth. A staggering figure. This outflow investment was the supply of sterling.
Wow. So the pre-WWI UK shows it is possible to have the top global currency without needing those persistent trade deficits.
It certainly suggests that under those specific historical conditions, the gold standard, Britain's industrial and financial dominance, massive overseas investment, it was possible.
That really flips the script on the inevitable deficit part of the Triffin dilemma, makes you rethink things.
It does. It shows there might be other ways to manage the responsibilities of a reserve currency, although the context was very different.
Which brings us squarely to the US dollar today. We often hear that argument, don't we? That the US trade deficit is just the price of being the world's bank.
Yes, that the world demands dollars, so the U.S. has to supply them, and that often means running trade deficits, buying more than we sell.
And this is financed by what they call the exorbitant privilege.
Right. That benefit the issuer gets being able to borrow more easily, maybe more cheaply, because everyone needs your currency and assets. Our source mentioned the U.S. goods trade deficit is currently around, what, $1 trillion a year?
$1 trillion, yeah. It's a huge number. And the Triffin logic seems to fit.
It's a very common application of the dilemma, yes.
But as we just saw with the pre-WWI UK, maybe it's not the only factor. Our sources also point out, quite rightly, that domestic things matter too, like low U.S. national savings rates.
Exactly. Domestic factors are a huge part of the equation. The dollar's reserve status arguably makes it easier to finance the gap between U.S. investment and U.S. savings.
Right, the privilege helps pay for it.
But it doesn't necessarily cause the low savings rate in the first place. That's driven by other things: government budget deficits, household saving habits, etc.
Okay, so it's intertwined. The global role enables the domestic imbalance, perhaps.
That's a good way to put it. They interact. So thinking about the future then,
Yeah.
what could actually trigger a change, a turnaround in this U.S. situation?
Well, the sources mention loss of confidence. That seems like a big one.
Confidence is key.
If foreign investors start doubting U.S. assets, maybe because of worries about government debt, political instability, geopolitical setbacks, or even a really bad economic crisis here.
Yeah, if they feel holding dollars or U.S. treasuries isn't safe or won't offer good returns anymore, they might start looking elsewhere. That could definitely shift things.
What else?
Well, the rise of credible alternatives. If another currency, or maybe a block of currencies, starts looking really stable, attractive, offering deep markets,
Like the euro, or maybe the yuan someday, or something else entirely.
potentially. If alternatives emerge that can genuinely challenge the dollar's dominance in various functions, that could reduce demand for dollars over time.
And global savings patterns, could they change?
Yes, that's another factor. If countries that traditionally run big surpluses and export capital, think China, or oil exporters sometimes if they start saving less and consuming more domestically.
Then there's less capital looking for a home in U.S. assets.
Exactly. Less fuel for the U.S. financial account surplus. And then, of course, U.S. policy itself could trigger changes.
Like what kind of policies?
Well, things like aggressive protectionism could forcibly reduce imports, though that has other consequences. Or, perhaps more constructively, a serious effort at fiscal consolidation.
Fiscal consolidation meaning getting the government budget deficit under control.
Basically, yes.
Yeah.
The government reducing its borrowing, taking steps toward balancing its books. That would reduce the U.S.'s overall need for foreign capital.
Okay, so several potential triggers. If a turnaround does happen, how might it play out? The sources sketch out a few scenarios, right? Some sound pretty rough.
They do. One possibility is what you might call a disorderly unwinding. This is the scary one.
Okay.
It involves a rapid loss of confidence. Capital flight money pulling out of the U.S. quickly.
What would that look like?
You could see a sharp crash in the dollar's value, interest rates spiking upwards dramatically, stock markets tumbling, inflation soaring because imports become super expensive,
Ouch.
and a forced, painful reduction in the trade deficit, almost certainly triggering a severe recession. It highlights the potential fragility.
Okay, that's the nightmare scenario. What are the alternatives?
Well, another path is a gradual structural shift.
Yeah.
Much slower, less dramatic.
How would that happen?
Maybe driven by that rise of alternative currencies we talked about,
Hmm.
or those changing global savings patterns. It wouldn't be a sudden crisis, but more of a slow burn.
So what would we see then?
You might see the dollar gradually depreciating over years, maybe moderate upward pressure on U.S. interest rates, U.S. asset prices not growing as fast as those elsewhere, and a slow, steady narrowing of the trade deficit.
Less painful, but still a big change over time, a relative decline in that exorbitant privilege.
Exactly. A less abrupt adjustment, but an adjustment nonetheless.
And the third scenario involves the U.S. kind of taking the lead.
Right. An orderly U.S.-led adjustment. This would be driven by deliberate U.S. policy changes.
Like that fiscal consolidation we mentioned. Or maybe policies to boost private savings.
Precisely. If the U.S. consciously decides to save more and rely less on foreign capital, the trade deficit would likely shrink because overall domestic demand would be lower.
What would happen to the dollar and interest rates then?
It's actually a bit ambiguous in that case. It depends on how markets react. Do they see the fiscal prudence as positive, boosting confidence? Or do they worry about slower U.S. growth? The effects aren't as clear-cut as in the crisis scenario.
So looking at those three, What do the sources suggest is most likely?
I think the general sense is that the gradual structural shift
Yeah.
is probably the most plausible long-term trend, just because these big global systems tend to change slowly.
But there's always that risk.
But there's always that persistent underlying risk of a disorderly crisis if confidence suddenly snaps. That threat hangs over the current system.
Which brings us to another huge question. Can the U.S. actually, balance its books, cut that current account deficit without losing the dollar's top spot?
The $1,000,000 or maybe $1,000,000,000,000 question.
It sounds like trying to have your cake and eat it too. What would need to happen? It involves flipping the capital flows.
It does. The U.S. would have to transform from being a net importer of capital to a net exporter of capital.
So instead of money flowing in to buy U.S. assets, U.S. money would be flowing out to invest abroad.
More U.S. money flowing out than foreign money flowing in, yes. That net outflow of U.S. capital would then become the primary way dollars are supplied to the rest of the world, kind of like the U.K. pre-WWI.
Okay, but for that to work, several pretty big things would need to fall into place, wouldn't they?
Absolutely. Condition number one, a significant sustained increase in U.S. national savings, both government savings, meaning smaller deficits or even surpluses.
Unlikely anytime soon.
Politically very challenging, yes. And also higher private savings from households and businesses. Policies would need to really incentivize that.
Okay, more savings. What else?
Condition two, the rest of the world would still need to want to use and hold dollars, even if they weren't earning them directly through trade surpluses with the U.S. anymore.
So the dollar needs to remain attractive for other reasons.
Exactly. Deep, liquid U.S. financial markets, trust in U.S. institutions, the inertia of existing systems, those network effects again. Confidence would still be paramount.
And third?
Third, there would need to be attractive investment opportunities outside the U.S. for all that American capital to flow into.
So theoretically possible.
Theoretically, you can map it out, but the practical hurdles are immense.
Especially the politics of boosting savings and cutting deficits.
Huge political challenges. Plus, there would likely be a difficult economic adjustment period. And there's still uncertainty if the U.S. government issues fewer treasury bonds because it's borrowing less. Would that actually diminish the dollar's appeal as a reserve asset, since treasuries are so central?
Right, it could backfire in a way.
It's complex. So, possible on paper, but requires transformative policy shifts and faces enormous real-world obstacles.
This whole tension, this Triffin dilemma, it really flared up again after the 2008 financial crisis, didn't it?
It absolutely did. The crisis exposed a lot of vulnerabilities in the global system.
And our sources mentioned the head of China's central bank actually pointed the finger at the Triffin dilemma.
Yes, the governor of the People's Bank of China explicitly named the dilemma as a root cause, contributing to the global imbalances that fueled the crisis. He even proposed moving away from just the dollar.
Towards what?
Towards using the IMF's special drawing rights, the SDR, more significantly as a global reserve asset, trying to diversify away from reliance on a single national currency.
It's funny, wasn't Keynes arguing for something similar way back at Bretton Woods? Bancor, he called it?
He was. John Maynard Keynes advocated for an international currency, Bancor, precisely to avoid the kind of problems Triffin later identified. But, well, the U.S. position won out at the time.
And have SDRs really taken off since 2008?
They've been expanded, their role has been discussed a lot, but no, they haven't come close to replacing the dollar. The system has proven very sticky.
The IMF itself looked into this stuff too, right? Around 2010.
Yes. One source mentions an IMF report from 2010 that seriously examined these issues, the feasibility of using SDRs more, even the radical idea of a global reserve currency managed by a global central bank.
Wow. Big ideas.
Shows the level of concern and the search for alternatives, even if the practicalities are daunting. It highlights the ongoing debate about the system's flaws.
Okay, one last piece to connect here. This relationship between the U.S. trade deficit and the financial account surplus, they're tied together, right?
Absolutely. Fundamentally linked. It comes down to basic balance of payments accounting.
Can you walk us through that identity again?
Sure. Very simply. The current account, which is dominated by the trade balance, exports minus imports, plus the financial account, which tracks cross-border investment flows. Those two have to roughly balance out to zero.
So if one is negative, the other has to be positive by roughly the same amount.
Exactly. If the U.S. has a current account deficit, meaning we're spending more abroad than we're earning, mostly through a trade deficit, then it must have a financial account surplus of a similar size.
And that financial account surplus represents?
The net inflow of foreign investment needed to finance that spending gap. Foreigners are essentially lending to the U.S. or buying U.S. assets, filling the hole left by the trade deficit.
Is it fair to say one causes the other? Like, does the trade deficit force the financial surplus, or does the desire of foreigners to invest here allow the trade deficit?
Ah, the causality question. Economists debate that. You can argue it both ways.
It seems like they happen together.
In reality, they're interdependent and simultaneous. They are two sides of the same coin, reflecting how the U.S. economy, with its specific savings and investment patterns, interacts with global capital flows.
So an increasing U.S. trade deficit automatically implies an increasing U.S. financial account surplus.
Intrinsically linked, yes. They effectively determine each other within the global economic framework. You can't really have one without the other under current structures.
Okay, so let's try to wrap this up. This deep dive. We've covered a lot of ground.
We certainly have.
We saw the Triffin dilemma in action with Bretton Woods collapsing and the earlier struggles of the British pound.
Yep, the classic examples.
But we also saw that counterexample.
No.
The pre-WWI UK managing to be dominant with current account surpluses, supplying pounds via capital export.
A crucial point, challenging the inevitability of deficits.
Then we looked at the US dollar today, the pressures, the arguments about deficits, the potential triggers for change.
And those scenarios, from the scary, disorderly unwinding to a more gradual shift, or maybe a U.S.-led adjustment.
And we touched on the immense difficulty of the U.S. balancing its books while keeping the dollar central, and the fundamental link between the trade deficit and financial inflows.
And hopefully you, our listener, now have a much deeper appreciation for just how complex this all is. The dollar's role isn't simple. It comes with these built-in tensions.
It really is a system with a fascinating history and, well, an uncertain future.
Absolutely.
So, on that note, maybe a final thought for you, our listener, to chew on. Given everything we've discussed, the inherent tensions of the Triffin dilemma, the historical precedents like Sterling and Bretton Woods, the unique case of pre-WWI UK, what developments in the next decade do you think will most significantly shape the future of the international monetary system?
Good question to ponder.
Think about that mixed economic policy choices in the U.S. and elsewhere, big geopolitical shifts, maybe the rise of central bank digital currencies or other financial technologies. How will these forces interact?
It's a question with no easy answers, that's for sure.
But one that will definitely define the global economic landscape for years to come. Thanks for joining us on The Deep Dive.